Well, the markets have had a pretty good run towards the end of the year here in 2024. Part of that could be tied to an expected deregulatory approach by the incoming president in Donald Trump. But we've also had to keep a close eye on the labor markets, inflation, the Fed and its cutting of rates, and much more. A pleasure to have joining us once again to talk over the year, Jeremy Siegel, Wharton Emeritus Professor of Finance. Hi, Jeremy. How are you today?
I'm good. Thank you, Dan.
Always pleasure to talk to you at the end of the year and kind of look back and look ahead. How do you view 2024 for the markets and finance in general?
Well, we've had two really fantastic stock market years, exceeded my expectation this year, another 20% plus gain on top of what we had in 2023. I expect it to be more muted next year. And I'm thinking that I see equities being 0 to 10%. I think there's going to be some cool off on the tech, a fantastic run. Now, I don't say that with, I'm not going to bet my life on that because the trend is so strong. The narrative is still strong.
Right.
Tech still is outperforming. AI is still strong. But there seems to be possibilities of more competition and some slowdown in that area next year.
I was going to ask you, what do you think are those dynamics at play then that might lead to a little lower returns?
Well, I think there's a number of things. Is AI being adopted as fast as people believe? There's been some articles that some firms have been disappointed in some of the results. Is there going to be competition for NVIDIA, their Blackwell chips? We have some pushback from China. And of course, all of this is on top of the big uncertainties of President-elect Trump's tariffs and immigration policy.
The deregulatory side, let me ask you about that because that obviously is an area that a lot of businesses are focusing on. It feels like assumed that we are going to, almost take the cover off the top of this and ease things where businesses will have a greater opportunity to be able to make some of the moves that they believe they need to make.
Yeah, and it's interesting because we have a monthly NFIB, which is National Federation of Independent Businesses sentiment indicator. And I was looking back 8 years ago, and it recorded after Trump was elected, two huge jumps. I think some of the biggest jumps in history. And indeed, another big jump. So those are small business, independent business, medium-sized business who are, feel that they could be burdened by this regulation. They are very optimistic. Now, there were a lot of deregulations taking place during Trump's first term. I can't say for certainty, how many might have been reversed during the Biden presidency.
Right.
But clearly, I think people are saying, hey, you know what? Things were pretty good for those smaller businesses during Trump's first term, and they're hoping for a repeat in 2025 and 2026.
You mentioned the tariffs. That obviously will be an important component. President Trump has already talked about the potential of tariffs for Canada and Mexico and China. The question, I guess, that's out there, and probably you're wondering it just as much as everybody else is this truly going to be a negotiating tool, or is he bound and determined to enact tariffs on these countries?
Well, I think it will, start as a negotiating tool. The bottom line, both with this and the immigration, is nobody knows. I mean, just a week ago, we had a big interview, Jay Powell on the Fed, and he was asked the same questions, and he said there's no way we act preemptively. Nobody knows what actual tariffs are going to be. No one really knows what exactly the immigration policy is going to be. It's really wait and see. Those are two big uncertainties. But if we take, the experience of the first term where he also threatened tariffs and did institute some, which, by the way, most of them were kept on, as we know, by the Biden administration. I regard it still mostly as a negotiating tool. He loves to come in with a very strong position and negotiate down from there.
Right. Right.
And he has to be aware that of the inflationary consequences and the consequences on businesses. Remember, he is the most outspokenly pro stock market president we have ever had,
Right. Right.
who measures his success as a president against, as one of the major factors is how well does the stock market do. So I think the financial markets are going to have a lot of say. They could give the thumbs down on some of his policies. Now, I'm not going to say some might hurt some firms and help others. We know that as a mix. But it would be surprising to me if he pursued policies that were highly detrimental to the economy, because that would be reflected right away in the stock market.
Right. And so we've seen this past year, earlier this year, we saw the Dow cross 40,000. This month, we've seen the NASDAQ cross 20,000. When you talk about things maybe cooling a little bit, you're not really talking about a correction, but maybe just a little bit of a slowing of the tremendous pace we've seen the last 2 years.
Yeah, that's my median forecast. But as we all know, Dan, the the 1 year, as we say, standard error of stock market returns is 20%. It means that it could be up 20, down or 0, up 10, down 10,
Right.
or even more extreme than that. It is so hard to predict on a 1 year. But with valuations being for the entire market on the high side, I don't think they're crazy. And I think, as I've often said, the tech firms, the Mag 7, have brought home the bacon. They produced earnings growth of 25, 30%, but they're 1/3 of the market.
Right.
I could see them cooling in 2025 to maybe be flat on the whole, and that would give the other 493 stocks a chance to shine. They're selling at a much more reasonable price earnings ratio, 18 to 20, and the smaller stocks even below that. But we know the S&P as a market is selling at 22 times earnings. Now, it was higher in 2000. And I think the equilibrium should be around 20, so it's within the range of equilibrium. But
Right.
clearly, valuation as a whole is not going to be the accelerator of the market taken broadly, which include all those tech stocks.
Let me switch gears a little bit and talk about the Federal Reserve, which, as we get ready to end the year, the Fed has made a couple of cuts. The expectation for 2025 is what, in your opinion?
Very few cuts. I believe that they, will make a cut on their December 18th meeting. It will be a hawkish cut, which means they will cut, but then say they're in for a pause and awaiting the uncertainties of the new Trump administration to resolve, as well as the direction of inflation. I do not project another cut in January. And in fact, my belief is, we may, if we have another cut now, we'll get down to around 4.25. My feeling is maybe only 50 basis points cut next year. So we're going to be 3.5, 3.75 on the Fed funds rate. And this is far higher than the Fed's own long-term estimate,
Right.
and
Right.
actually higher than their estimate that they gave in their September FOMC meeting.
Right. Wasn't it the projection of closer to like 3 to 3.25%, or maybe even a touch lower than that, as the expectation of what that target
expectation in September, their long run was 2.9, actually.
Yeah. Yeah.
I expect on the December 18th meeting that they will be raising that to 3.0 or 3.1. They're a little lagged and slow sometimes in that. My personal belief, Tom, is that we're going to be the real what's called R star or natural rate under a 2% inflation, given the stimulus to the economy, the deficits, the uncertainty, is really probably between 3.5% and 4%. So I'm 60 to 100 basis points higher than the Fed September call on that. So and that means, of course, that long-term bonds, if we're really towards a normalization of the interest rate structure, of course, which Fed Chief Powell has termed recalibration. Remember that under normal circumstances, long-term interest rates are above short-term interest rates.
Right.
And in fact, in non-recessionary times, by anywhere from 100 to 150 basis points. So if I think that, we're only going to get the Fed funds rate down to 3.5%, that means we'll see the 10-year at 4.5 to 5, or potentially even a little higher. And that is certainly higher than it is today.
There's a component of, and you mentioned this earlier, of the geopolitical that probably has to come into play here as well. Not only with what we've seen play out in Ukraine, but obviously in the Middle East, and the potential concerns with China as well. Those all have to be factored in when we're looking into the next 12 to 18 months, don't they?
Oh, absolutely. So, in addition to tariff policy, in addition to immigration policy, we have the potential of agreements. President Trump has said that he will enter the negotiations immediately on the Ukraine and on Gaza. And by the way, it seems like geopolitical developments in both places, and particularly in the Mideast with what has happened in Syria, might make the time right for a deal on both those fronts. That would take out a lot of uncertainty. It's far from a done deal, and things could spiral out of control rather than in control. I think the markets, by continuing to be strong in that, are actually hoping for settlements in those two troubled areas. Now, of course, there's that ongoing threat potential of China against Taiwan. It's not, anything, of course, shooting war as we have in the Mideast or Ukraine, but certainly a big potential. Chairman Xi in China and President Trump might try to get together to clarify that status,
Right.
but that is also very, very uncertain. I mean, again, fortunately, we don't have a shooting war in Asia yet.
We've talked about a lot here in the last 15 minutes. As you go into 2025, anything else that you are very watchful of as we head into the new year?
Well, I'm always watchful. I think of cybersecurity. Um, I think there are a lot of bad actors, state-sponsored and elsewhere. Um, I'm often asked the question, Professor Siegel, what keeps you up at night? And I said, well, I do actually sleep fairly well, but I'll tell you, I wouldn't like to wake up in the morning and try to get access to my bank accounts and brokerage accounts and find they're all locked out. And it's not just me, but it's a nationwide phenomenon. I mean, that could throw the world into chaos. We have to consider cybersecurity as important as our military preparedness on and spend a lot of resources to make sure that's there. We also, of course, have potentials on the grid. Will it be strained? We know the power requirements of AI are strong, and there's a lot of people working on that question, trying to provide more energy. That's one reason why utilities have actually done fairly well over the last year and a half. But I think those are two other areas where we certainly need to spend resources if we are to realize the potential gains from artificial intelligence.
Jeremy, always a pleasure to talk with you. And again, I look forward to chatting with you as 2025 rolls on. Thanks again.
I'm here for you, and I'm sure we'll talk again later. Thank you.
You got it. Jeremy Siegel, Wharton Emeritus Professor of Finance.